With example 3, guys, you are given trading stock worth 800,000. This is a pre-adjustment trial balance for the year ended 28th February 2016. Under the balance sheet section, you've got trading stock worth 800,000. What I need you to remember is that these are simply balances for the year ended. So these are the balances at the end of the year. However, what you need to read, guys, carefully here is the fact that they said to you, consumable stores on hand is 600,000, and that balance is on the 1st of March 2015. If the end of the financial year is the 28th of February 2016, it means that the beginning of the financial year was the 1st of March 2015. Telling you that that consumable stores on hand balance of 600 Rand is right here. So that is the balance at the beginning of the financial year. These are consumable stores that were not used last year. Remember, I said to you, whenever you're dealing with consumable stores, it's simply your expense that may not be expensed because it was not used. Things like stationery may only be expensed when used. We did not use 600 worth of consumable stores on hand last year. I don't know what that consumable stores on hand was for. It might be for stationery, it might be for packing material, it might be for cleaning material. I do not know, but I know it's one of those was not used last year. Meaning that before we can even try to buy new stuff of whatever was not used, we need to expense that 600 Rand first. We need to use that 600 Rand. Remember, when it comes to things like stationery that we are not selling, cleaning material that we normally use to clean our stores, and packing material, all of those will only be expensed when used. So since that packing material is from last year, it means that we're gonna start first by using that, not really packing material, I don't know what it is, but we're gonna start using that 600 Rand of consumable stores from last year before we can even buy new stuff. Under nominal account section, we've got the following expenses: packing material, which is 3,500, stationery, which is 15,000. Let us read the adjustments. The adjustment says, the bookkeeper did not do the reversal of adjustments for consumable stores on hand at the beginning of the financial year. It says the bookkeeper did not do the reversal of adjustment for consumable stores on hand at the beginning of the financial year. So that was supposed to have been expense. As I've said, it may not still be consumable stores in the current year. Note that this is the balance at the end of the year. It is still there. We may not have last year's balance of consumable stores at the end of the current financial year because that consumable stores was supposed to have been expensed in the current year. We may not have this balance over there because it was supposed to have been used, meaning that it was supposed to have been expensed in the income statement. That's what they mean by reversal. But we need to find out what made up that consumable stores. It says the consumable stores on hand consists of stationery that was not used in the previous year. meaning that we need to expense stationery. By expensing, we need to expense that 600 rand. It must be our stationery expense, so it must be added to our stationery expense. Basically, to this 15,000 here, we are going to have 600 plus the 15,000. 15,000 relates to stationery that we have bought, the net purchases of stationery in the current year, which will be 15,000. Now what we need to do first is to make sure that we add consumable stores that was there at the beginning of the year to the 15,000 rand. Basically, that's what needs to happen. What needs to happen is basically for us to add the 600 rand to the 15,000 rand, okay? And that 600 rand must be expensed in the current year. I'm just going to continue. Basically, this is what needs to happen. I'm going to have stationery here. Open brackets, I'm going to have 600 plus 15,000. I'm going to leave my bracket open because only stationery that was used for the current year must be expensed. So I need to minus any stationery that was not used. Number 2 says, a stock with a retail value of that, which is 525, was delivered to the store, basically to us, on the 28th of Feb, which is the last day of the current financial year, which is 2016. Kenneth marks up his trading stock at 50% on cost, so we're going to use that if we need the cost price. The transaction was not recorded. That tells you that our trading stock balance of 800,000 is understated because there is trading stock that was purchased but was only delivered on the 28th of February, and that trading stock was not added to the 800,000 rand that we have above. That tells you that I need to take my trading stock of 800,000 and add the cost price of the trading stock that was purchased. But I don't have that cost price, so I will need to calculate the cost price, which is $525 multiplied by 100 divided by 150. And that will give us 350 rand. That 350 must be added to the 800,000. Making our trading stock to be 800,000 rand, 350. Then we're going to go to point number 3. Point number 3 gives us that trading stock, and in brackets they said stock mentioned in item 2 was included in this 770. That 770 is our trading stock balance as per stock count. on the 28th of February 2016. That is what we have in our warehouse. This tells us that the trading stock that we have in the trial balance of 800,350, or in our books, in our records, okay, of 800,350, that amount is incorrect. So we need to adjust that value to the actual value of trading stock, which is 770,000. That tells us that we need to adjust our books down. And when you adjust your trading stock value in your books down, you will have trading stock deficit. Your trading stock deficit will be the difference between the stock that was counted and the adjusted amount of our trading stock. The difference between these two values will be 30,350. This 30,350 will be what we refer to as trading stock deficit, and that must be recorded in our income statement or the statement of comprehensive income. That's it. The stock that was counted will also be recorded under our inventory note. And the amount will be going back to the transactions. Then they said, on the same day, we counted stationery worth 600. So that is the closing balance of our stationery. As I've said, that 600, it tells us that 600 worth of stationery that we had was not used. So what do we need to do with that 600? You go back to the statement of comprehensive income and then you minus 600 rand. Meaning that your stationery expense for the year will be 15,000 rand. Then they say packing material that was not used, as per stock count, obviously, it will be 1,500. Stock count on the 28th of February 2016 revealed the following on hand. What's on hand means it was not used. Packing material not used for the current year will be 1,500. I have to go to my operating expenses, and under my operating expenses I'm going to have packing material. The value of our packing material given in the trial balance is 4,500. I need to minus packing material that was not used of 1,500, and I'll be left with 3,000 rand. Then you're going to add up all your operating expenses. will get 48,350. And that will be my total operating expense for the year. Then you're going to go to your inventory note. Write consumable stores on hand. This relates to all consumable stores that were not used, your stationery that was not used, or packing material that was not used, or simply your cleaning material that was not used. For our stationery, 600 Rand worth of stationery was not used. And for packing material, 1,500 of our packing materials was not used. Add the two, you will get our total consumable stores on hand of 2,100, making our inventory total to be 772,100. In our journals, we are simply going to process all the adjustments that were not recorded. The first one will simply relate to our stationery, all right? Unfortunately, I don't have enough time, so I will erase. That increases our expense. Our expense was supposed to increase by 600. That is from 15,000 to 15,600. The 15,000 comes from the balance of stationery we had in the trial balance. And then I needed to reduce my consumable stores. This is an asset account, therefore it will decrease on the credit side. This is what you were supposed to have done. So this is the reversal of consumable stores that were not used from last year. We need to expense it because that opening balance wasn't supposed to have made it to the end of the current financial year as an opening balance. It was supposed to have been expensed during the year. As a matter of fact, it was supposed to have been expensed right at the beginning of the financial year. Then we're going to look at trading stock. We've got trading stock deficit that we calculated, which was 30,315, and then we needed to credit our trading stock by that amount. Note that here we're crediting our trading stock balance of 800,350. 800,350. It must go down by 30,350 to be 770,000. That's why we're reducing the total amount by 30,350, which is our trading stock deficit. When it comes to consumable stores on hand that were not used at the end of the current financial year, you will debit consumable stores on hand because that is your asset. It represents your inventory. And the amount will be 2,100. What made up that 2,100 is the fact that we need to reduce our stationery buy stationery that was not used on the 28th of February 2016. So we're going to reduce our stationery from 15,600 to only 15,000 because we have to subtract the 600 that was not used. And the amount was, then we have to reduce our packing material on hand. Our packing material expense. By packing material that was not used, which was, so that's why we've got those two credit entries. The first one, it's simply your debit of consumable stores, which represents your assets, which are simply your trading stock, your stationery and packing material that was not used. However, we need to reduce our stationery expense. Remember, our stationery expense is sitting at 15,600, which is the 15,000 of net purchases for the current year, plus the 600 of stationery that was not used from last year. We're going to have to expense it, so we're going to add it to our stationery. And then we minus the stationery that was not used at the end of the current financial year of 600 rand. That 600 rand is the one that we're crediting here. This is all you are supposed to have done with respect to example 3.